Welcome to the Wealthsteading Podcast. This is episode 496. Today is October 16th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, hey, the market's a little bit in turmoil again today, and that begs the question that a lot of people are asking, is this a market top? Are we about to have a meltdown? Is the AI bubble about to burst? Well, listen, I can't predict the future, but I want to make an argument about how even if you buy at the top of a market, it may still work out just fine for you, depending upon a couple things, okay? We're going to talk about that right now because I know all over social media and YouTube and everywhere else, TikTok, you're hearing people that are making crazy predictions, either that one asset class or another is going to the moon or that everything's about to fall apart. Listen, these people don't know anything. None of us do. That's the whole point to investing. There are risks involved, and nothing is a sure thing. Well, one thing is a sure thing. If you don't ever invest, then your money's never going to have a chance to appreciate. So let's talk about that. What if you end up buying into the market right now, and we are at a dreaded market top? Well, I'm here to tell you, with my over 40 years of experience, if you have a diversified portfolio, and if you have a long-term outlook, then history tells you, if you're investing in United States equities, that over the long run, you're going to be fine. Here's why. We talk about the stock market, but it's not a stock market. It's a market of stocks. So even right now, the market's down a little bit, but we're still pretty darn close to all-time record highs on most of the major indices. But that's the index. That doesn't mean that individual stocks aren't at incredible buy points, assuming you're looking for something that's discounted or maybe underpriced. Right now, as I record this, the S&P is only down about 2% from its all-time record high, which was, literally just a week ago. So if you bought in right now, yeah, maybe you are getting in at a record high. Is that top of the market? Well, we don't know, do we? We won't know until after it's all worked out. But regardless of whether we're at a top or not right now, you have to keep in mind that the market's always at a top, even when it goes on to put on all-time new record highs, because that's the nature of a growing, expanding economy. If you don't believe the United States is a growing, expanding economy, then, well, you're probably not listening to this podcast anyways, and you shouldn't be investing in United States equities. I don't happen to share that opinion, though. I think we're living in the most prosperous times in the history of humanity, and the future's just as bright now as it ever was. In fact, more so. Yeah, but I digress. Hey, getting back to S&P 500. Yeah, it's just 2% from a record high. But dig down into the numbers. It's a market of stocks, not a stock market. A stock market correction occurs when the market is down at least 10% from its 52-week high. Well, right now, while the index is only 2% from its all-time record high, you have over 63% of the stocks in the S&P 500 that are down by at least 10%. So theoretically, a vast majority of the S&P 500 is already in a correction. So there's probably a lot of discounts out there, if that's what you're looking for. Okay, so let's dig into that a little further. Not only are over 63% of the stocks in a correction, you've got more than 33% that are in a full-fledged bear market where they're down at least 20% from their 52-week high. You don't think you can see some bargains and some opportunities there? Well, I think you can, because a full 44% of the S&P 500 right now is trading below its 200-day moving average, which effectively means that if you bought any of those stocks today, you'd be getting it as good or better of a price than had you bought, in the previous 12 months. So yeah, the market's at a record high, it's near a top, but that's the index. There are still a lot of individual stocks which have already fallen apart in price. And so if you are that bargain hunter, maybe they're already out there. You have to not look at the market as an index, but look at the overall universe of stocks and see which ones are rotating either up or down. Speaking of rotation, again, you don't hear much about the Mag 7 anymore because they're not so magnificent. But think about how much you still hear about NVIDIA. It's a great company. It's in my portfolio. I think it was up over 30% so far year to date. But all those big names, NVIDIA, Microsoft, Meta. Well, look how the market has rotated over the last 10 months or so. You know what stocks have drastically, and I mean drastically, outperformed those big Mag 7? We'll take a look at the performance of companies like Intel, Broadcom, Oracle, AMD. And hey, if you want some real explosive growth, especially in some old stodgy tech companies that everybody thought were dead, take a look at Micron and Seagate. Yeah, that's what I'm talking about with stock rotation. It's always happening. It's always occurring. And let me give you some recent examples from what I have done this year. And I'm going to start out talking about some great trades, but listen all the way through because I'm making a point here that no, I can't predict the future and I'm not a genius and I strike out. But first, let's talk about some good, solid base hits. Last January, talking January 2025, this past January, I made 3 specific trades. You can see those. They're all archived over at investablewealth.com under the blog and alert section. And when I made those trades, the market at that time was at all-time record highs. I had no idea what it was going to do the day after I bought those stocks. But I wasn't making those investments for the short term. I firmly believe in what I've been calling the convergence of industrials and technology. And I think this is a long-term trend and certainly going to work out for the next 3 years or so. So when I was buying this past January, even though we were at record highs, I wanted to get into a particular category of stocks. And as I talk about these, you'll see that this is a large number of stocks and with some broad diversification, not just in the industrial tech sector. That's what diversification is all about. You're diversifying in other markets as a hedge, just in case. And again, I wasn't buying these for performance over a month or 3 months or 12 months. I wasn't trying to beat the S&P 500. I was trying to solidify and get into positions that I thought would work out over, let's say, the next 3 years. So how did some of those work out? We'll take a look at the trades that I made on January 6th. I bought about 65 stocks that day. And in aggregate, I'd say the performance of those 65 stocks are up something like 17, 18%. That's even with the recent pullback. That's pretty darn good in comparison to the S&P 500, which year to date is up about somewhere under 13%. Now, I'm not claiming that I always beat the S&P 500. In fact, I rarely beat it. That's never my objective. My objective is to preserve and grow my wealth, regardless of what the S&P 500 does. I just point this out as an example to show you that, 10 months ago, when I was buying into a market that was already at a record high and potentially topping out, it's still up 17, 18% from then. And those stocks all weren't winners. In fact, there was a lot of losers. That's why I invested in 65, because I didn't know which one or two was going to do the best. But there were some losers. Some of them is down, down as much as 20, 30, 40, 50 some percent. Health Catalyst has been a total dog. Honeywell, Zebra, Becton Dickinson. Yeah, they've all been total disappointments. But go back and listen to that podcast that I did earlier this year about losses being limited and gains being infinite. Because while I had some, big losses in those purchases I made back on January 6th, yeah, pull up. Seagate, Micron, I already mentioned them as being extreme outperformers. Lam Research, Corning, Amphenol, Howe Aerospace, Oracle, Zscalers, Huntington Ingersoll Industries, Snowflake, United Rentals. All these stocks have done incredibly well over the past 10 months. And I'm just giving you a sampling of those 65 stocks, but you get the idea, right? They are diversified. But hey, it gets better. Because look at my blog post from, it was right around January 31st. I bought another 30 stocks or so that day. Now, some of these I was doubling down on. I already owned them. For example, Seagate, I went back and bought more of it. Yeah, unfortunately, I bought more of Zebra too, which as one of my losers. But you know what? Those 30 stocks that I bought at the end of January, in aggregate, they're up something like over 35%. You don't believe me? Pull up that list. Take a look at them. And I want to emphasize here, again, the market was at or near a record high when I did that. Worse than that, the market went on to fall apart on Liberation Day in April. But I held my positions. I didn't care. Remember, I was buying these for the long run because I believe in the thesis that we are in an inflection point in the economy, and this intersection of industrial and technology is going to be a growth area like we haven't seen before. Now, I may or may not be right about that, but in terms of those purchases that I made at the end of January, they're doing amazing right now. Yeah, but you know what? I'm not a genius. I can't predict the future. I infrequently beat the S&P 500. Let me give you an example of that. Let's forget about this year. Let's go back to last year, 2024. And again, this is archived. You can see it on my website. Around June 25th, 2024, I bought 10 stocks that day. Take a look at the list on the website. There were some great ones in there. This is especially focused on the industrial side of my tech industrial theme. And there were some great performers, like Norfolk Southern, up since then over 38%. There was also Lincoln Electric. I think I did a whole episode on that not too long ago. That's up a good 30% since the summer of 2024. So some good solid winners among those 10, but you know what? There were also some horrible losers. I thought that the chemical industry had bottomed. Well, it hasn't. It continues to go down. I haven't yet sold most of those chemical companies. I still own them. As we get into 2026, I'll make the decision of whether I want to write those losses off in, a new year or not. But for now, I'm holding them. And you know what? They're abysmal. Olin, down 50% since I bought it. Eastman Chemical, down 39%. So on that day, in the summer of 2024, a full more than a year and a half ago, those cumulative 10 stocks, they're not only drastically underperforming the S&P 500, they're losing me money overall. And if you factor in dividends, maybe I'm breaking even, but that's certainly nothing to brag about. Listen, that's just one example of where things didn't work out. I don't know if you've ever played baseball or not, but if you have, I'm sure that there's been times in your life when you struck out, right? You don't always get a base hit or hit a home run when you go up to bat. The same thing carries over to investing. Don't try and perfectly time the market. And most importantly, don't get fearful or greedy. Have a long-term horizon. Listen, if you're not looking out 3 to 5 years, you shouldn't be investing. And again, you should be diversified. And in my opinion, the way the market's structured today, simply investing in the S&P 500 in the capital weight version is not diversified because the vast performance of that index is based on, anywhere from a handful to a dozen stocks. So know what you own and make sure you're diversified and be in it for the long run. Hey, I'll close out on one thing that I find funny. Some of you may not like this comment, but many of the people right now that I hear from that are so worried about the S&P 500 or the NASDAQ or AI stocks being at all-time record highs, do you know what they're happy to pile into? Yeah, they're out there buying gold. Have you seen a chart of gold lately? Now, I'm not predicting gold's going to crash. I have no idea. Again, I can't predict the future. But zoom out on a gold chart. You'll see that when markets fall apart, gold generally does too. Go look at what happened to it in 2008. No, it didn't fall apart as bad as the overall market, but it still had significant losses. And the problem with being invested in something like gold is you're not diversified. You're in one single asset class, and individual asset classes, especially gold, again, look at the chart, they can go through extremely long cycles. And if you buy in at the top of gold, you can be looking at 10 to 20 years before you get your money back just in nominal terms, not even counting inflation. Hey, and I'm not even going to talk about digital Amway right now. In any case, one more thing to paint a rosy picture on where we are in the stock market. And again, I'm sitting in a minimum of 20% cash right now. I'm not saying we're not going to get a pullback. I'd love to see one because I'd like to put my cash to work. But you know what? Take a look at productivity gains and how that's correlating with the stable cost of labor right now. Because when it comes to corporate profits, about the most important element is the cost of labor. So when labor costs are stable or at least not rising as much as the rate of inflation, and when productivity is improving, that's a major tailwind to corporate profits. And I'll throw in two other areas that are very important to corporate profits. Energy and the cost of money. Look at where the 10-year Treasury is right now. It's finally dipping down. 10-year Treasury is below 4%. That means interest rates on things like mortgages and, more importantly, corporate debt are going to be going lower. And how about the cost of oil? West Texas Intermediate right now is at $57 a barrel. That's more than 20% lower than it was, over the last year or two. This economy still, for the most part, runs on petroleum, and when oil prices are down by more than 20%, that's going to offset a lot of core inflation. Hey, in any case, just my rose-colored glasses opinion of the economy. Come on back for more analysis. Until then, as always, this is John Pugliano wishing you the very best returns.